2008, institutional investors who recognized the market patterns made billions buying distressed multifamily assets. Now, today we're seeing a similar disconnect between asset prices and market fundamentals. But here's the trillion-dollar question. Will this opportunity be even bigger? The data from this year's NMHC, or National Multi-Housing Council meeting, suggests we're approaching something unprecedented in real estate history. So let's examine 5 major warning signs that sophisticated investors are watching closely. First, we're seeing a complete freeze in deal flow. Major institutional investors are sitting on unprecedented amounts of dry powder. We're talking about hundreds of billions in capital specifically earmarked for multifamily acquisitions. Yet transactions have been ground to a halt. Why? Because something fundamental has shifted in the market dynamics. Second, there's a dangerous divergence between seller expectations and market reality. See, property owners who purchase assets during the low interest rate environment are refusing to sell at discounts, even as debt costs have doubled. This standoff can't continue indefinitely, and smart money knows it. Third, we're witnessing a quiet exodus of institutional capital from traditionally core markets. Cities like LA, San Francisco, and New York are being systemically redlined by sophisticated investors due to regulatory risks. This isn't just about rent control anymore, it's about the fundamental ability to operate profitably in these markets. Fourth, construction costs and rising insurance premiums are making new development virtually impossible to pencil out in most markets. This is creating a perfect storm where supply will inevitably contract sharply just as demographic trends drive increased demand. But here's what no one else is talking about. The multifamily industry is about to experience its largest consolidation in history. Small to mid-sized operators are getting crushed by a triple threat of rising insurance costs, expanding regulatory pressures, and operational inefficiencies. Meanwhile, large institutional players are quietly positioning themselves for massive portfolio acquisitions at discounted prices. The parallels to previous market cycles are striking, but this time the opportunity could be even more significant for well-positioned investors. So let's dive into the hard data from this year's NMHC Council meeting, the industry's gathering of the institutional investors and national market players. First, let's look at supply trends. After years of aggressive development, construction starts are finally declining. New multifamily permits are down 40% year over year. Construction costs have risen 28% since 2021. Labor shortages continue to delay timelines. But here's where it gets interesting. Despite the challenging environment, apartment demand remains remarkably robust. Migration patterns continue to favor rental markets. Home ownership remains out of reach for many households, and population growth in key markets exceeds new supply. The lending landscape is also shifting dramatically. Banks are returning to construction lending, but with a crucial difference. Loan-to-cost ratios are returning to 60 to 65%. Regional banks are actively seeking new relationships, and construction loans are becoming more favorable. Perhaps the most telling, major institutional investors are widening their buy boxes for the first time since 2020. They're now looking at Class B assets in prime locations, value-add opportunities in strong submarkets, and development deals in high barrier to entry markets. This shift in institutional strategy typically precedes major market movements. Most investors think high interest rates are the biggest threat to multifamily returns, but they're wrong, and here's why. The real danger facing the market is threefold. First, regulatory risk has become impossible to monitor effectively. Traditional core markets are seeing unprecedented policy shifts, rent control, new screening restrictions, complex eviction moratoriums, and environmental compliance regulations. One major institutional investor at NMHC put bluntly, LA is an institutional market until I sell everything we have there and then it isn't. Second, operational costs are rising faster than revenue in many markets. Insurance premiums are highly unpredictable, labor costs continue to climb, utility expenses are increasing, and property tax assessments are aggressive. But the hidden threat that few are actually discussing is the coming wave of debt maturities. Between 24 and 26, over $800 billion in multifamily debt will need refinancing. Many properties will face negative leverage, smaller operators will struggle to recapitalize, and forced sales could flood certain markets. This combination of factors is creating one that NMHC speaker called a perfect storm for consolidation, the point of no return. Here's one indicator that sophisticated investors are watching obsessively: the spread between construction costs and achievable rents. In every major real estate cycle of the past 50 years, when this spread hits a certain threshold, it triggers a supply correction that lasts for years, and we just hit that threshold in Q4 of 2023. So let's break down why this matters. Construction costs have risen 28% since 2021. Rents have increased only 12% in the same period. Development yields have compressed below return requirements, and land prices haven't adjusted to the new reality. This imbalance means new construction is becoming impossible to pencil out in most markets, setting up a potential supply shortage by 2026. Now, the historical data is ambiguous. Between 1974 to 76, supply dropped 65% over 24 months. 89 to 91, supply contracted 58% over 18 months. In 2008 to 2010, supply fell 73 over 30 months. Today's conditions could suggest we can see even more dramatic correction. Here's how sophisticated institutional investors are positioning themselves for the coming reset. Location strategy. They're targeting specific asset profiles, 20 to 40-year-old properties, high-income suburban locations, strong school districts, diverse employment drivers, and business-friendly municipalities. 2. Market selection. The consensus favored markets for the next 5 years are Dallas and Fort Worth, Charlotte, Raleigh, Durham, Columbus, Nashville, Phoenix, Northern Virginia, Richmond, Hampton Roads. Timing strategy. Smart money is prepping now. Building relationships with regional banks, securing debt commitments, strengthening operator relationships, creating management efficiencies, and stockpiling dry powder. 4. Operational focus. Elite operators are prioritizing implementation of AI and automation, centralization of key functions, bulk purchasing programs, energy efficiency improvements, and insurance cost mitigation. Remember what Sam Zell did in the early 1990s? He built the largest multifamily portfolio in the history by acquiring assets during a period of market dislocation. Today's conditions are creating similar opportunities for well-positioned investors. Now, the multifamily market is approaching a pivotal moment, but here's an even bigger story developing in commercial real estate that could accelerate this entire timeline. In our next video, we'll break down the 1.2 trillion commercial real estate debt coming due in the next 18 months. The implications for multifamily investors are staggering. Here's what you need to understand: which markets will see the most distress, how bank failures could accelerate the timeline, and where the smart money is already positioning. What strategies are being deployed now? So click the link above to watch the analysis. You'll want to see it before anything major investment happens in 2025. And don't forget to subscribe and hit the notification bell to stay ahead of these market shifts. Smart money is already moving, so make sure you don't miss out. And following the principles of Warren Buffett, be fearful when others are greedy and greedy when others are fearful. Right now, the market is fearful, and that spells opportunity for more informed investors. See you next time.